My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. I'll be my friends. I was trying to make you a little money. My job, not just to entertain, but to educate. Do some teaching. Call me, 1-800-743-CNBC. Tweet me at Jim Cramer. Another day, another softer economic number, another step closer to the Fed no longer being your enemy. After this cooler than expected consumer price index reading we got at 8:30 a.m., it's now clearer that Jay Powell, the Fed chief, is actually winning the war on inflation, which is why the Dow jumped 217 points today, S&P gained 0.34%, and the Nasdaq advanced another 0.64%. That was on the sixth straight month of better inflation numbers. So in the eve of earnings season, we can stop worrying about the big picture and talk about what makes individual stocks go higher. Why don't we start with the basics? Tomorrow we'll hear from most of the big banks. They'll unleash a slew of numbers. Most of them will be actually irrelevant to the stocks, but not all of them. What do we care about? Loan growth, defaults, how much money they're making off your deposits. They're paying you nothing. They're getting 3-4%. We'll see a set of headline numbers, the earnings, the revenues, the forecast. It'll look simple, but it's never simple with the banks. And their numbers are often impacted by an amalgam of one-time considerations, which throws off our ability to make clean apples-to-apples comparisons with the analyst estimates. Now, most of the time, the bank stocks instantly go higher, or at least most bank stocks. And then we listen to the conference call, the tone, the refinement of the forecast, the question and answers. And then what happens? They give up their gains. Probably happening again tomorrow. We'll also be hearing from BlackRock's Larry Fink. Now, he's the man behind the biggest asset gatherer in the world. He is a titan and a great advocate of your rights, shareholders' rights, shareholder democracy. And that's something I'm going to be talking about with him tomorrow on Squawk on the Street. Which brings me to what I really want to talk about tonight. Oh, I could give you a couple of NASDAQ stocks that are up. Everybody knows how to do that, right? Oh, hey, look at that semiconductor. No, I want to do a little more. I feel like doing a little more tonight. I want to talk about democracy in the case of the Walt Disney Company. First, let me tell you, like anyone who bought Disney last year, I would say I'm plenty upset. And this is for my charitable trust. We've lost a lot of money on a situation that I felt very bullish about, and I was wrong. I've liked Disney forever, though. I've been to Disney World a dozen times. I brought my kids up on Disney movies. I can't live without ESPN. Disney stock is the first stock I recommended on Mad Money almost 18 years ago. So I'm neither a summer soldier nor a sunshine patriot. So when it comes to Disney's recent performance, believe me when I say that I am furious. This company has not done a good job. It's canceled its dividend. It's lost billions, squandering a stunning amount of shareholder money. Let me repeat. Shareholder money. Like my money. Or at least my trust. Like your money. You see, like other publicly traded companies, Disney's actually owned by the shareholders, who give their trust to the CEO and the board of directors to do a great job with their money. And, well, at least that's supposed to how it works. But some chief executives don't seem to recognize that they're accountable to anyone. Some boards don't think so either. Now, that doesn't really bother me all that much when the stock's doing well, unless we discover some sort of, like, truly awful criminal enterprise. But when the stock's doing poorly, I think management loses that right to be treated with the congenial, hail fellow, well-met attitude that I have, that kind of Jeffersonian Gandhi thing I do. And when the company loses fortunes, like Disney did when they surprised us with $4 billion loss for its direct-to-consumer product last year, more than double the previous year's loss, you know what? I don't wear gloves, but I'd take them off if I had them on. I'm not going to just throw the towel and walk away. Management point blank has done a terrible job here. Bob Chapek, the CEO, was fired for his mismanagement, and the board brought back Bob Iger's predecessor, to try to restore order. They also named board member Mark Parker, the fantastic chairman and former CEO of Nike, as the new Disney chairman. Now, it's true that Disney's doing badly, but some of its problems had nothing to do with the deposed Chapek, who was picked by Iger in the first place. Remember, they spent $71 billion buying Fox's entertainment assets. That was a colossal overpay that ruined the balance sheet.
The House of Pain.
Reckless use of shareholder money, your money, my trust money. Sure, hindsight's 2020. Disney had wanted Fox to augment its new streaming service, but like a general manager who spends too much, way too much, on a single, excuse me, on a single player. Well, look at that, I missed the water. Bob Iger needs to be held accountable. Believe me, if Disney were a football team, every ESPN analyst would say that whoever was involved with the Fox acquisition deserves to be fired. Something Disney should know, because, well, they own most of ESPN. That's not cruel. I'm not being mean. Here's what I'm really doing. I am stating what I call facts. Those are facts. Then not long ago, with Disney stock trading not far from its lows, a well-known activist investor, a guy named Nelson Peltz, he took about a $900 million position in the company. It's not chump change. He, like every shareholder, was unhappy with the company's performance, didn't think that Chapek was doing a good job. Again, obvious. Peltz asked to be put on the board to help the company perform better. In November, when Chapek was fired and Iger returned, many thought that Peltz would be appeased, let Iger bring back the magic. The magic. Peltz wasn't appeased. Now he's going to be, let's say, going to be, thrilled with the team that bought Fox? What he says was $30 billion more than what it was worth. He's supposed to like that? Now, here's what's key. Peltz runs a hedge fund, Triumph Partners. When Peltz joins the board of a Triumph position, as long as he's on the board, the company tends to outperform the S&P 500 by 9 percentage points in any given year. 9 percentage points. The CEOs of the companies he has helped have given him glowing testimonials, even the ones like Heinz and Procter & Gamble, where he had waged proxy fights to get on the board. During the time he's been on the boards, he's helped increase investments to drive sales growth and market share performance, reduce cost and overhead, and optimize capital allocation decisions, all of which are things that Disney could use. Which is why I found it so confounding that Disney's board has given Peltz a definitive no, despite how poorly the company's performing. They gave him a token 45 minutes to make a presentation. Originally, it was only supposed to be 30 minutes. Peltz pleaded for another 15. And then shortly after, they said, no, thanks. We don't need you on our board. They told him he could observe things, kind of like auditing a class at college. But his $900 million skin-in-the-game position seems to mean nothing to them, nor does his wisdom. I'm obviously actually trying to be as dispassionate as possible about this, but I don't understand why Disney wouldn't eagerly welcome basically free advice from someone with a tremendous track record when he's on the board. I've done my own reporting on this and found many directors who've served with him. They all say the same thing. He's thoughtful, helpful, not disruptive. If you're going to have an activist shareholder coming after you, Peltz is the one you want. So now lots of money, your money, if you're a shareholder like my Travel Trust, will be spent to stop Nelson Peltz from joining the board. Boy, is that nuts. Even though he's not the guy who was involved with the disastrous Fox acquisition or the disastrous choice to make Bob Chapek the CEO. Sure, Disney will have its excuses, just like P&G did when they fought against Peltz. CEO even came on the show to campaign against him on their proxy contest. They tell you all sorts of stories about how it'll hurt the culture, disrupt the boardroom, whatever. But you know what? We're the shareholders, and the shareholders are the ones who own Disney. It's the board, the stewards, who haven't done a good job, not the shareholders and not Peltz. Now someone like Peltz has been tremendously successful, wants to join them, and they act like that's a problem? That is lunacy. Here's the bottom line. We're not talking about naming Dopey or Sleepy or Scrooge McDuck, one of my faves, or Pluto or the Teacup or the Sultan or the Beast or the Little Mermaid to Disney's board. Talk about electing someone named Nelson Peltz, who can and will help. Hopefully the existing board members who caused Disney to lose so much value won't prevail in arguing against taking it. Let's go to Ira in Texas. Ira.
Yes, how you doing? Thanks for taking the call. You've always mentioned take companies that have good products or good services. Last week, your analyst talked favorable about healthcare management companies. What's your read on Teladoc? They're in that telemedicine space.
Well, excuse me, my problem with Teladoc is that they have not fulfilled, they made a really bad merger, frankly. And when they did that merger, that blew them up. I don't want to touch it. I think there are a lot better ideas out there. Bob in Indiana. Bob.
Hey, what's up, Jim?
Not much, Bob. How about you?
Pretty good. Just waiting to go into work.
All right.
So I diversified my portfolio with Mullen. I bought that around 19 cents. I sold out of Apple to get there, but with my Amazon, I sold out of there, and I bought roughly 750 shares at $1.60 approximately on Bed Bath & Beyond. And I'm deciding whether or not if I should go
here's
ahead
what I
and
think
put
you
the
should
rest
do.
of my
Okay,
stock-
look, here's what I think you should do. Bed Bath & Beyond has said that it's worried about being a going concern. What that means is that they could shut, they could close, they could sell. But the main thing you need to know is that you have a cost basis that you can take out. You let the rest run, that's fine with me. But I don't want you to lose money in this. This thing could go to zero, and you'll say, why didn't I take anything out? Take out your cost basis tomorrow, let the rest run, and see how you do, and I think you'll be fine. All right. Hopefully the existing board members who caused Disney to lose so much value won't prevail in arguing against Nelson Peltz's help. On Mad Money tonight, Denbury has a handle on all things carbon capture. So could the stock be an under-the-radar green energy play that's also highly profitable? I'm talking to the CEO. Then over the last couple of months, a phenomenon has swept Wall Street. Former CEOs returning to right the ship. So what should you make of these high-profile power transfers? I'll give you my take. And could the latest COVID numbers out of China be a worry 3 years after COVID initially made it to our shores? I'm getting the latest from the one and only Dr. Eric Topol, and you won't like it. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.